Have you ever felt just, well, overwhelmed by all the financial advice out there, wondering if there's maybe a simpler, more powerful way to approach your investments? Something that actually cuts through the noise? Welcome to the Deep Dive's latest book talk on finance.
Yeah.
Today, we're diving into a book that offers a remarkably different perspective, The Warren Buffett Portfolio by Robert G. Hagstrom. And what's really compelling, I think, is that Hagstrom didn't just theorize, he actually put these principles into practice himself.
Yeah.
He managed the Legg Mason Focus Trust with what he called very encouraging results.
Yeah, it's fascinating how this book builds on his earlier work, The Warren Buffett Way. Hagstrom really aimed to fill in what he termed the blank spaces and understand Buffett's complete approach. He drew on insights from some pretty diverse fields too. You know, people like mathematician Ed Thorpe on probability, Charlie Munger on the whole psychology of misjudgment aspect, and even Bill Miller's thinking on complex adaptive systems. So this book, when it came out February 1999, it really does round out the picture of his investment philosophy.
Okay, so our mission in this book talk is to really unpack Hagstrom's insights into focus investing. And just a heads up, this method might just challenge, well, pretty much everything you thought you knew about navigating the stock market. And hey, if you find this discussion insightful and want to keep exploring complex topics made clear, definitely hit subscribe for the deep dive on YouTube. We'd love to have you. Right then, let's set the stage. Hagstrom's book paints this picture of portfolio management as kind of constant tug of war, right? Between two main strategies most of us know.
Exactly. Yeah, when you look at the investment landscape, most people tend to lean towards one of two main paths. First, there's what we call active portfolio management. This is where managers are constantly buying and selling loads of stocks, often, over 100, with turnover rates maybe around 80%. The idea is they're trying to predict short-term swings and beat the market. But the reality, as Hagstrom points out, is pretty stark. By late 1998, something like 90% of these actively managed funds were actually underperforming the market.
90%.
Yeah, averaging about 14% lower than the S&P 500. And that's even before you factor in the inherent costs of all that frantic trading activity.
Wow, okay. 90% underperforming by 14%. That's pretty damning. So active management often just ends up meaning less money for the investor, sounds like. What's the other option then?
Well, the other side of that coin is index investing. This is much more passive. It's a buy and hold approach, basically designed to just mimic a benchmark like the S&P 500. Now, it's certainly better than most actively managed portfolios in, quite a few ways, mainly because the costs are way lower. But as the book highlights, the trade-off is you'll only ever get exactly the returns of the overall market. Never better, never worse. Both strategies, really, from an investor's point of view, they share this common attraction, trying to minimize risk through broad diversification, spreading your bets wide. But Hagstrom argues we've become sort of intellectually numb to its inevitable consequence, mediocre results, which really raises an important question for you listening. Are you actually satisfied with just average returns? Or could you perhaps do better?
And I guess that's the perfect lead-in to where Hagstrom introduces focus investing. He calls it this powerful third alternative, the one Warren Buffett champions. It sounds simple on the surface, but as we dig in, you see there's real depth, solid thinking toward it. What's the core idea?
Yeah, at its core, focus investing is about this. You choose a few stocks that are likely to produce above-average returns over the long haul. Concentrate the bulk of your investments in those stocks and, this is key, have the fortitude to hold steady during any short-term market gyrations. Buffett's main strategy, as Hagstrom explains it, isn't about watching share prices day to day. No, he focuses most of his attention on analyzing the economics of the underlying business, assessing its management. He uses this specific set of investment tenets, kind of like his tool belt, to find those good companies that really make sense for a focused portfolio.
Right, so thinking like a business owner, not just someone trading stock certificates. Where did this whole less is more idea come from for Buffett? Was it always his approach?
A really big influence on him was Philip Fisher. Fisher deeply believed in owning just a small number of outstanding companies that he understood well. He thought that was far better than owning a large number of average ones, many of which, frankly, he felt he understood poorly. Famously, he'd limit his portfolios to fewer than 10 companies. And often just 3 or 4 of those would make up like 75% of the total investment.
Wow.
He had this great quote, "Buying a company without having sufficient knowledge of it may be even more dangerous than having inadequate diversification."
That really hits home. So how did that kind of thinking translate into the Buffett's actual strategy? Did it make him more willing to, go big when he found one of those companies?
Absolutely. Fisher's influence really taught Buffett to put big bets on high probability events. When a really strong opportunity came along, like his famous American Express purchase back in 1963, Fisher's philosophy meant making a large, very concentrated investment. This approach is also basically the antithesis of a broadly diversified high-turnover strategy. It demands patience. You have to patiently hold your portfolio even when it appears that other strategies are marching ahead. Hagstrom suggests a turnover rate of only maybe 10 to 20%, which implies you're holding things for, 5 to 10 years on average. And crucially, you have to learn to not panic over price changes. Look, price volatility is just a necessary byproduct of focus investing. Sure, broad diversification offers that sort of psychological comfort, smoothing out the bumps along the way. But Hagstrom warns a smooth ride is flat. When you average out all the ups and downs just to avoid feeling uncomfortable, what you get is average results. Focus investing, on the other hand, explicitly pursues above-average results. It accepts that the ride will be bumpy, because the bet is that the underlying economics of those few great companies will more than make up for any short-term price swings.
Okay, this focus investing concept sounds incredibly powerful, but I have to admit it also sounds, well, a little scary if you're used to spreading your risk thin. Has anyone actually made this work consistently in the real world? Or is it just a nice theory?
Oh, it's definitely not just theory. Hagstrom highlights several investors he calls the super investors of Buffettville who really embody this approach. Take John Maynard Keynes. Yes, that Keynes, the famous economist. Many people don't realize he was an active investor. He managed the chess fund at King's College, Cambridge from 1927 all the way to 1945. And get this, he achieved an average annual return of 13.2%. Compare that to the overall UK market, which basically stayed flat during that entire period.
13% versus flat, that's huge.
It is. His core principles were careful selection of just a few investments, holding them steadfastly, and maintaining a balanced overall position. Now, it's important to note his fund was volatile, almost 2.5 times more volatile than the general market. But at the end of the day, he outscored the market by a significantly large margin.
Teams. Wow. I never would have guessed. Who else is in this Buffettville club?
Well, naturally, there's Charlie Munger, Buffett's longtime partner. He always had this poker player mentality. He believed you have to bet heavily when you've got huge odds in your favor. Munger even felt that owning as few as 3 really good stocks could be plenty if you could handle the psychological ups and downs. And then there's Bill Ruane. He founded the Sequoia Fund, which Hagstrom points to as basically the first mutual fund run explicitly on focus investing principles. They kept it incredibly tight, typically owning between 6 and 10 companies that made up well over 90% of the entire portfolio. Very low turnover, too. And the performance, an impressive average annual return of 19.6% compared to the S&P 500 over its history up to the book's writing. Ruane really stressed doing deep, intensive company investigations, not just relying on Wall Street reports. And one more, Lou Simpson. He managed Geico's equity portfolio for years, a very similar style to Buffett. He focused Geico's billion-dollar equity portfolio on fewer than 10 stocks. Between 1980 and 1996, this led to an average annual return of 24.7% compared to the market's return of 17.8% over that same period.
Okay, Keynes, Munger, Ruane, Simpson. That's quite a lineup.
Definitely. And the common thread, the shared intellectual approach among all these super investors is twofold. First, they reduce risk by buying stocks only when there's a significant margin of safety, a big, favorable gap between what they calculate the business is truly worth, its intrinsic value, and its current market price. Second, they concentrate their portfolios on these carefully selected, limited number of high-probability events. Hagstrom argues this combination both reduces risk, because you understand what you own so well, and helps to generate returns far above the market rate of return.
That's a powerful set of examples. But, anecdotes are one thing. Did Hagstrom back this up with any broader sort of statistical evidence? Does focus investing actually work on average, statistically speaking?
He absolutely did. And it's one of the most compelling parts of the book, I think. He and Joan Lamb-Tennant conducted this really interesting study, a kind of laboratory universe. What they did was assemble thousands upon thousands, I think it was 12,000 hypothetical portfolios. They varied the sizes from highly concentrated 15 stock portfolios up to much more diversified ones with 50, 100, even 250 stocks. Then they simulated their behavior over long historical periods. And the key finding was really striking. Hagstrom says, in every case, when we reduced the number of stocks in a portfolio, we began to increase the probability of generating returns that were higher than the market's rate of return.
So fewer stocks meant a better chance of beating the market?
A significantly better chance, yeah. Look at the numbers. Out of 3,000 simulated 15-stock portfolios, 808 beat the market. That's roughly a 1 in 4 chance. There, compare that to the 250 stock portfolios. Out of 3,000 of those, only 63 beat the market. That's more like a 1 in 50 chance. The conclusion, Hagstrom argues, is pretty much inescapable. You have a much higher chance of doing better than the market with a focused portfolio. But, and this is a critical but, you also have a much higher chance of doing worse, which just hammers home how absolutely crucial intelligent stock selection is. It's not about just picking any 15 stocks, it's about picking the right 15 stocks.
This deep dive really does challenge our core assumptions, especially about what good performance even looks like. If those short-term price wiggles aren't the main thing, what should you be looking at? How do you gauge if your investments are actually, doing well?
That's a great question, and it gets to the heart of Buffett's philosophy. He's famously dismissive of short-term market prices. He once said something like, when the price of a stock can be influenced by a herd on Wall Street, set at the margin by the most emotional person or the greediest person or the most depressed person, it is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical. The book calls relying on price and then evaluating it over very short periods of time. Like those quarterly mutual fund rankings we always see. It calls that double-barreled foolishness. It just creates this senseless short-term game where fund managers feel pressured to churn their portfolios, constantly buying and selling, even while they're advising their own clients to buy and hold. It's contradictory.
Yeah, that quarterly ranking pressure must be intense.
Totally. And it leads to bad decisions. The reality of focus investing, Hagstrom shows, is more like the tortoise and the hare. Even those super investors of Buffettville we talked about, they had significant periods where they underperformed the market. Keynes underperformed at a third of his 18 years. Munger, 36% of 14 years. Ruan, 37% of 27 years. Imagine underperforming for nearly 10 years out of 27. Simpson, 23% of 17 years. Bill Ruan from Sequoia, he once talked about suffering the Chinese water torture of underperforming the S&P 4 straight years. 4 years. But of course, Sequoia Fund eventually surged way ahead because the underlying businesses were doing well. This is why numerous academic studies, Hagstrom cites Carhart, Malkiel, others, have found basically no meaningful correlation between past persistence and future performance. Chasing last year's winner, bouncing from one hot fund to the next, it does nothing to aid investors in building their net worth.
Okay, so if chasing the hot hand is a fool's errand and short-term price isn't the real measure, what is the alternative? How does a focus investor actually benchmark their success? What's the scoreboard they should be watching?
Buffett's preferred method, the one Hagstrom champions, is what's called economic benchmarking, or focusing on look-through earnings. Essentially, you look at the total earning power of the actual businesses you own a piece of. You calculate it as the earnings per share of each company multiplied by the number of shares you own in that company. Your job as a portfolio manager, or just as an individual investor managing your own money, isn't to guess prices, it's to find ways to raise the benchmark, to grow the underlying earning power of the collection of businesses you own.
Focusing on the earnings of the companies themselves, that makes intuitive sense.
Right. And this directly leads to what Hagstrom calls the sloth-like approach, where inactivity strikes us as intelligent behavior, being lazy in a sense, but for smart reasons. This has two huge benefits. First, obviously, reduced transaction costs, all that buying and selling in active funds. It racks up brokerage fees, bid-ask spreads, costs that directly subtract from your returns. Hagstrom cites a Morningstar study which found that funds with low turnover ratios, defined as less than 20% per year, generated significantly higher returns over a decade, about 14% higher, on average, than funds with turnover rates over 100%. Costs matter. A lot.
15% higher just from lower turnover. That's substantial.
It really is. And the second benefit is perhaps even more powerful over the long run. Increased after-tax returns. See, when you hold on to a winning stock without selling, the gain isn't taxed yet. Buffett famously calls this unrealized gain an interest-free loan from the Treasury. You get to keep that deferred tax working for you, compounding over time. Hagstrom gives a powerful example. Imagine a $1 investment that doubles every single year for 20 years. If you sell it, pay the tax, say thumb 4%, and reinvest the rest each year, you end up with maybe $25,000 or so after tax. But if you just held that same investment for the full 20 years and only sold and paid tax at the very end, you'd walk away with closer to $692,000 after tax. The difference is staggering thanks to the power of tax-deferred compounding. Oh, that's a massive difference. It's huge. And research by Jeffrey and Arnott, mentioned in the book, found something counterintuitive. The biggest tax damage to a portfolio actually happens right at the start of high turnover. Their conclusion: For the best after-tax returns, investors should probably aim for an average annual turnover somewhere between 0 and 20%. So it really makes you ask yourself, are you potentially paying unnecessary taxes and kneecapping your own long-term compounding just by trading too frequently?
Okay, let's pause and unpack this a bit more. Hagstrom seems to be arguing that mastering focus investing isn't just about finance know-how. You need to broaden your toolkit, understand things like human behavior, probabilities, even complex systems. That's quite a shift. What does that really mean in practice? How does understanding, say, psychology help you pick stocks?
It's about recognizing that investing doesn't happen in a vacuum. It involves probabilities, human emotions, and dynamic systems. Hagstrom dedicates significant parts of the book to these areas. First, let's take the mathematics of investing, specifically probability theory. He paints the stock market as this inherently uncertain universe. Your job as an investor isn't to predict the future perfectly. You can't. It's to narrow the field, identify and sort of remove the most unknown elements, and focus your attention and capital on the least unknown. That whole process is fundamentally an exercise in probability. Now, sometimes you can calculate probabilities with simple math, like rolling dice, or you can use historical data, like car insurance rates, that's frequency distribution. But often in investing, you're dealing with unique situations. What's the probability this specific company will succeed with its new strategy? There's limited direct data, so you have to rely on subjective interpretation. This means using your knowledge, your analysis, your judgment to sift out the unreasonable and illogical in favor of the reasonable. You're essentially making an educated guess about the odds.
Okay, so assigning probabilities even when things aren't clear-cut. How does that connect to making decisions?
Well, Hagstrom brings in Bayesian analysis,
Yeah.
which sounds complex, but the core idea is simple. You start with your initial probability assessment, and then you constantly update it as new relevant information comes in. Your odds change based on new evidence. Buffett puts this very practically. He says something like, take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do. It's expected value thinking. He used this when he bought Wells Fargo back in the early 90s during a nasty recession. The market panicked, hammered the stock down 50%. But Buffett looked at the actual business, assessed the probability of permanent damage as low, and figured the potential upside was much greater than the remaining downside. He saw the odds of making money in the order of 2.1.
So it's about weighting the potential outcomes by their likelihood.
Exactly. And related to that is the Kelly optimization model. This is a fascinating concept that actually came out of analyzing blackjack strategy, developed by John Kelly at Bell Labs. At its heart, it's a mathematical formula that tells you what fraction of your capital you should bet on an opportunity to maximize your long-term growth rate, given the probability of winning and the payoff odds. The key lesson for investors is about mathematically linking degree of probability to investment size. Simply put, bet bigger when the odds are heavily in your favor. Make your best ideas your biggest positions. But Hagstrom includes important cautions here. The Kelly model assumes a very long time horizon. It assumes no leverage or borrowing, and critically, it can lead to wild swings if you bet the full amount calculated. So most practitioners, including sophisticated investors, use a half Kelly or a fractional Kelly model, betting less than the formula dictates, just to build in an extra layer of safety, a double layer of protection.
Okay, probability, sizing your bets, that makes sense. But you also mentioned the psychology aspect, Charlie Munger's psychology of misjudgment. How critical is that? Are we really that irrational when it comes to money?
According to Munger, absolutely. He apparently resisted studying psychology for years until he realized, as he put it, his attitude was costing me a lot of money.
Yeah.
He directly challenges the whole efficient market hypothesis, the idea that markets are always rational. He asks, but since when are people rational about money? Munger's view, which Hagstrom details, is that the entire market is pushed and pulled by psychological forces. Our brains evolved using mental shortcuts or heuristics, which are useful in many contexts, but can make us easily misled and prone to manipulation when dealing with complex systems like markets. So Munger advocates for a two-track analysis. First, look at the rational factors, the business fundamentals, the valuation, but then also consider the subconscious influences, the potential psychological biases at play, both in yourself and in the broader market.
What kind of biases are we talking about?
Oh, there are many, and behavioral finance is a whole field now. Hagstrom touches on several key ones. There's overconfidence. Investors routinely believe they're smarter than everyone else. They overestimate their skills and their knowledge. What does that lead to? Often a great deal of trading because they think they can time things perfectly. Then there's overreaction bias, sometimes called investor myopia. People tend to put too much emphasis on a few chance events, especially recent news or short-term performance. Hagstrom cites a classic study by Richard Thaler involving hypothetical portfolios. Students who got frequent updates showing volatile short-term results allocated only 40% to stocks. But students who only saw smoothed-out periodic results, like every 5 years, were comfortable allocating almost 70% to stocks. The frequent noise made them overly cautious. Thaler's tongue-in-cheek advice became, invest in equities, and then don't open the mail.
Huh. Don't look, basically.
Pretty much. Another huge one is loss aversion. Psychologically, the pain of a loss is far greater than the enjoyment of a gain. Studies suggest people need twice as much positive to overcome a negative. This explains why people often hold on to losing stocks way too long. Selling would mean crystallizing that painful loss. It also makes the volatility of focus investing hard for many to stomach. And there's mental accounting, the weird habit we have of shifting our perspective on money as surrounding circumstances change. Treating found money like a tax refund differently than hard-earned salary, for instance, even though a dollar is a dollar. The bottom line, Hagstrom stresses, is this. To fully understand the markets and investing, we now know we have to understand our own irrationalities. The study of the psychology of misjudgment is every bit as valuable to an investor as the analysis of a balance sheet and income statement.
So it's as much about managing your own mind as it is about managing your money. Okay, what about the last piece, the market as a complex adaptive system? How does thinking about it that way change how you invest?
It primarily reinforces Buffett's strong stance. Don't waste your time trying to forecast the macroeconomy, the direction of the overall market, or even short-term movements in individual stock prices. Buffett says something like, the fact that people will be full of greed, fear, or folly is predictable. That human nature part is constant. But the sequence, however, is not. You can't predict when these emotions will dominate or how exactly they'll play out market-wide. This view contrasts sharply with classical economic theory, which often relies on equilibrium systems, kind of like Newtonian physics, neat, predictable, balanced. But Hagstrom argues those models are just too rigid to describe life's richness. Instead, he presents the market and the economy as complex adaptive systems, CAS. Think of vast networks of interacting agents, people, companies, banks, all acting in parallel based on their own local information and experiences. Control is highly dispersed, not centralized. The system is constantly learning, adapting, evolving. A key feature of CAS is that they will never be at rest. If the economy actually reached some perfect equilibrium, Hagstrom quotes complexity theorists saying, it wouldn't just be stable, it would dead. Change and adaptation are inherent.
Okay, so if the system is constantly changing and adapting in unpredictable ways, how does that help?
It helps by telling you what not to focus on. Hagstrom uses the El Ferrell bar problem as a metaphor. It's a thought experiment by Brian Arthur about a bar where people decide whether to go based on whether they expect it to be too crowded. If everyone thinks it won't be crowded, they all go, and it is crowded. If everyone thinks it will be crowded, they stay home, and it's empty. There's no stable prediction possible because everyone's actions affect the outcome. Hagstrom relates this to things like surveys of institutional investor sentiment. Merrill Lynch used to track how bullish or bearish top investors were. The patterns showed these dramatic changes in strategies, kind of echoing the El Ferrell problem, everyone reacting to everyone else's expected reactions. Keynes's famous beauty contest metaphor captures the same idea, trying to guess not who you think is prettiest, but who average opinion thinks average opinion will find prettiest. It gets very recursive and unstable.
Right, trying to guess what everyone else is guessing.
Exactly. And Hagstrom's conclusion is blunt. We are no closer to solving the problem of how to predict the behavior of such a system at the macro level. But, and this is the crucial insight for focused investors, while the economy and the market as a whole are too complex and too large to be predictable, there are patterns at the company level that we can recognize. You can analyze an individual business, understand its competitive advantages, assess its management, estimate its earning power. That's where Buffett focuses his energy. He embraces the market's short-term irrationality. As he says, uncertainty is the friend of the buyer of long-term values. Market noise creates opportunities for the business analyst. Bill Miller, another investor Hagstrom cites who thinks deeply about complexity, echoes this. Miller says, the economy is too complicated to forecast. You'll never add any value to a portfolio by conforming it to an economic or market forecast. But Miller found that understanding complex adaptive systems helped him think more creatively about the market's complexity. For instance, it helped him see companies like Dell and Compaq not just as head-to-head competitors, but potentially occupying different niches within the broader tech ecosystem. Miller also makes a key point about valuation models. Historical valuation models work as long as the context is similar to the context in which the valuation methodologies were first established. But when the context shifts dramatically, like the rise of technology companies fundamentally changing the composition of the S&P 500, then investors need to evolve their mental models too. You can't just rigidly apply old formulas to a new reality.
Okay, we've covered a lot of ground. The critique of traditional investing, the principles of focus investing, the super investors, the importance of probability, psychology, complexity. This book talk really does lay out a compelling, if challenging, roadmap for becoming what Hagstrom calls a .400 hitter in the financial game. Can you maybe boil it down? What are the core actions, the key principles someone listening right now should really take away?
Absolutely. Hagstrom does a great job of distilling it down. He extracts 8 key principles from studying those super investors. If you want to emulate their success, here's what the book suggests you focus on. 1. Think of stocks as businesses. Really internalize that. When you buy a stock, approach it as if you were buying into a private business. Understand how it makes money. 2. Increase the size of your investment when conviction is high. Remember Munger. Bet heavily when you've got huge odds in your favor. Don't dilute your best ideas. 3. Reduce portfolio turnover. Embrace that inactivity. It lowers costs. And crucially, it maximizes those after-tax returns by letting your unrealized capital gain compound for longer.
Less trading, more owning. Got it. What else?
4. Develop alternative performance benchmarks. Get away from just watching the stock price day to day. Focus instead on economic-based models, like tracking the look-through earnings of the businesses you own. Is their earning power growing? 5. Learn to think in probabilities. This is fundamental. Charlie Munger has a typically blunt quote on this. If you don't get this elementary but mildly unnatural mathematics of elementary probability into your repertoire, then you go through a long life like a one-legged man in an ass-kicking contest. You need to understand odds.
Okay, message received on probability.
6. Recognize the psychology of misjudgment. Understand your own potential biases, overconfidence, loss aversion, herd behavior, and guard against them. Know thyself, investor. 7. Ignore market forecasts. They're generally useless for long-term investors and, as Hagstrom puts it, an expensive distraction. Focus on your companies, not the noise. And finally, number 8. Wait for the fat pitch. Be patient. Don't swing at every opportunity. Act decisively only when you find a situation where there's a significant margin of safety, when you can buy a great business at a price well below its intrinsic value.
That's a powerful list, but it sounds like a complete shift in thinking for many people, a lot to implement. Does Hagstrom suggest this is easy, or does it require real commitment?
Oh, he's very clear it requires commitment. He says explicitly, you do not have to be an MBA-level authority on business valuation to profit from the focus approach, so it's accessible. However, he immediately follows that by saying, it does require you to commit your time to studying the process. You have to put in the work to understand the businesses and the principles. Buffett's quote sums it up nicely. Investing is simpler than you think, but harder than it looks. It's not intellectually complicated necessarily, but executing it consistently, especially through volatile times, requires discipline and emotional fortitude. Hagstrom ends on a motivational note, suggesting that the success investors earn using this approach will eventually work to overthrow the less than effective model of hyperdiversification and high turnover. He sees it as a needed paradigm shift, but one that demands both defiance of conventional wisdom and faith in the long-term process.
Defiance and faith, I like that. Ultimately, this book talk and the book itself really forces us to confront a fundamental question about our own habits, doesn't it? Are we truly investing, or are we, maybe without even realizing it, just speculating?
It's such a crucial distinction, and Hagstrom brings in definitions from the greats to hammer it home. Keynes put it this way: investment is an activity of forecasting the yield on assets over the life of the asset. Speculation is the activity of forecasting the psychology of the market. Are you focused on the business or the mood swings? Benjamin Graham, Buffett's mentor, offered his classic definition. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting this requirement are speculative. Analysis, safety, satisfactory return. Those are the keywords for investing, and Buffett himself boils it down perfectly. If you're an investor, you're looking at what the asset, in our case, businesses, will do. If you're a speculator, you're primarily forecasting on what the price will do, independent of the business.
Business focus versus price focus.
Exactly. And Hagstrom's sobering conclusion is that much of the activity that dominates the financial markets today is speculation, not investing. People chasing tips, following momentum, reacting to headlines. That's largely speculation. What's the key differentiator? What separates investing from speculating, according to Graham, Buffett, and Hagstrom, it's knowledge. The greater your level of knowledge about the businesses you own, the less likely that pure speculation will dominate your thinking and your actions. Knowledge is the antidote to speculation.
Wow. So by really embracing the insights from this book talk, from Hagstrom's work, you can genuinely shift. You can move from feeling overwhelmed by all the market noise to making confident, well-informed investment decisions based on business reality.
Imagine just for a second what your investment journey could look like if you made a conscious choice to be a deep diver into businesses, really understanding a few well, rather than being just a surface skimmer of prices reacting to every ripple. What outstanding companies that you be overlooking right now simply because you're caught up in that short-term speculative game?
That's a powerful thought to end on. If you found this discussion insightful, if it sparked some ideas and you want to continue exploring complex topics made clear, definitely be sure to subscribe to The Deep Dive on YouTube. We'll keep bringing you more discussions and talks like this one, aiming to cut through the noise and get right to the heart of what truly matters. Thanks for tuning in.